Welcome to our Explainer, where today we're breaking down a really fascinating day in the market, December 16th, 2025. What a day! It was a classic story of push and pull, with two massive opposing forces going head-to-head. And the result? A market that looked completely split down the middle.
You know, the market sent out some seriously conflicting signals, and it all really comes down to this one central question. Is the incredible, almost unstoppable momentum in artificial intelligence strong enough to defy the heavy pull of a weakening economy? That's the big mystery we're looking at.
All right, first things first, let's get a quick snapshot of the closing numbers, because right away, you're going to see what I'm talking about. A clear split in performance that really sets the stage for the entire story.
So check this out. The tech-heavy NASDAQ, it pushed firmly into the green, powered by all the big names you'd expect. But then you look at the broader S&P 500, it slipped. And the more old-school Dow Jones, it fell even harder. This isn't just a mixed market, folks. It's a market with a split personality.
So what in the world was going on? What were these two powerful forces pulling the market in opposite directions? Well, it really boils down to this central conflict: the sheer excitement around AI versus this growing anxiety about the broader economy.
On one side of the rope, you've got this incredible optimism, this powerful growth engine surrounding the AI revolution. It's lifting specific stocks to unbelievable new heights. But on the other side, you have the heavy pull of macroeconomic gravity. I'm talking about worrying data on jobs and commodity prices that are making investors really cautious about everything else.
And the poster child for that AI engine was Tesla. The stock just surged, up over 3% to a new all-time high. And this was all fueled by a massive wave of optimism about its driverless robotaxi tests. It's just a crystal clear sign of how much investors are betting on the future of innovation.
But then, on the flip side, that macroeconomic gravity absolutely hammered the energy sector. It plummeted nearly 3%. Why? Because crude oil crashed to a 4-year low on news of potential peace in Ukraine, and, maybe more importantly, fears of slowing global demand, a really clear sign of economic anxiety.
So just to recap, these were the key drivers. You had the powerful, very specific tech story with AI, but weighing against it were these bigger economic signs. Now, the weak labor report, with unemployment rising, is kind of one of those weird bad news is good news situations. Some investors hope it'll force the Fed to cut interest rates, but that oil collapse, that signals real fear about a global slowdown. And bubbling under all of it, investor sentiment is running super hot, which, believe it or not, can be a warning sign all by itself.
So with such a divided, confusing market, what are the professionals saying? Let's take a look at how the experts are diagnosing this really complex situation.
Bank of America's big monthly survey is basically waving a giant yellow flag. They're pointing to extreme optimism, the highest in 4.5 years. And when everyone is this bullish and has already put all their cash to work, it often means the market is getting a bit fragile, that it could be vulnerable to a pullback. Think of it this way. Historically, these moments of peak optimism often come right before things cool down.
But then, in complete contrast, you have Citi painting a much rosier picture. They're seeing a Goldilocks environment. You know, not too hot, not too cold, just right, with solid growth and inflation under control. They're actually projecting a strong rally ahead, led by the very same tech stocks that were winning today. So you've got two huge banks with two totally different outlooks.
Then you've got BlackRock, which is offering a more balanced view, kind of a middle path. Their advice? Don't you dare abandon the powerful AI theme. But you gotta protect yourself. They're suggesting building in diversification through things like market-neutral strategies. Those are investments designed to make money whether the market goes up or down.
And this chart, wow, this really visualizes the warning from Bank of America. You can see right here that the average cash level that fund managers are holding has hit a record low of just 3.3%. This is the hard data showing that professional investors are pretty much all in. There's very little cash left on the sidelines to buy any potential dips.
Okay, so given this incredibly complex backdrop, you've got high optimism, conflicting economic signals, and experts who can't agree, how on earth is an investor supposed to navigate all this? Well, this brings us to some potential strategies.
First, let's just quickly look at a few companies that made big moves today and why. We already talked about Tesla's huge AI-driven surge, but you also had Oracle, another big AI player, bouncing back as bargain hunters jumped in after it had sold off. And then PayPal gained on news it's trying to move deeper into traditional finance, which is a whole different story about strategic growth.
So here's the bottom line. Navigating this market seems to involve a really clear choice between two very different paths. The aggressive path is to basically double down on the AI momentum, focusing on tech and industrial stocks and just riding that wave. The huge risk, of course, a sudden bubble pop. Then there's the defensive path, which is to hedge your bets with safer, low-volatility things like bonds or commodities. And the risk there? Well, you could miss out big time if the tech rally continues to defy gravity.
And that really leaves us with our final thought for the day. We've got a market being pulled between a powerful, maybe even revolutionary growth story in AI and some very significant, very real economic risks. With investor sentiment at a multi-year high, the question is, what's the next move? It's something that requires some very careful thought.